to Global Insights with me, Punita Kumar Sinha. Over the next 6 weeks, we will analyze and discuss the key trends that will impact world markets over the near term. As we are all aware, the Fed-induced quantitative easing is about to end. And even before it ends, we have seen that September has been the worst month for EM equities in 2014. EM equities fell about 7.4% and underperformed developed markets, which fell about 2.7%. While some of the poor sentiment was driven by happenings in China and rising geopolitical risk, the FOMC tone also sparked concerns of outflows from EM assets. We saw the US dollar strengthen, and we saw a falling oil price, which added headwinds to some of the larger oil-producing markets like Brazil and Russia. As QE ends, US interest rates will probably rise. What will this do to global growth? The IMF's forecasts are for a better economic growth globally in 2014 and 2015 at 3.4% and 4% respectively as of July 2014. So where do we go from here? To discuss the impact of QE withdrawal on India and emerging markets, we have with us two noted guests. Olivier Blanchard, Chief Economist at the IMF, and Gita Gopinath, Professor of Harvard University, who will join us later on the show. Mr. Blanchard, thank you very much for joining us today. Let me start with you first. IMF had reduced its growth estimates for emerging markets last year, but earlier this year, growth estimates have been revised up. Do you see that changing going forward?
Not much change for the group of emerging countries taken together. Some adjustments here and there, some adjustments up. I mean, India is one country where we're likely to revise up a bit. And other countries such as Brazil or Russia, where things are not quite as good as they were earlier in the year.
In April, you talked about the premature withdrawal of monetary stimulus being negative for economies. Do you still hold that view?
Yeah, we still do. We still think that we basically agree with what the Fed has said it was going to do, which is for the moment keep the rates more or less at zero, and sometime next year start increasing them. There's still an output gap in the US, in other advanced economies, so it makes sense to continue to have very low rates.
Given IMF's recent warning on excessive risk-taking, do you believe interest rates should be raised in the US and QE should end?
No, we don't think so. We see some indications of maybe excessive risk-taking in some markets, not in general, so we're not very worried. Clearly, the monetary authorities in the different countries should be monitoring this very closely. If it gets worse, I think that they should try to use what we call macroprudential instruments rather than increase interest rates. So again, no reason to increase interest rates for the time being.
Now, should US be raising rates given the recent fears of deflation in Europe? You know, we've seen the market's reaction ahead of the events, which hasn't been good. So what's your view?
Well, you have to distinguish between what's happening in the US and what's happening in Europe. In the US, it makes sense sometime next year to increase interest rates, no question. But in Europe, clearly at this stage, there is no plan to increase interest rates anytime soon. And they basically need all the help they can get from monetary policy. So the two situations are very different.
Given the less favorable external demand situation and the end of easy money, what are the prospects for emerging market growth long term?
Well, I think you have to think about potential growth in emerging markets. And I think the answer is that the kind of growth you saw in the first half of the 2000s is not going to come back anytime soon. You're going to be growing in general at very high rates, but not quite as high as before. And then the change in the landscape in advanced economies is going to have some effects. Stronger growth in the US is a good thing, but if it comes with interest rates being high in the US, it probably means higher interest rates in emerging market countries as well. So the world is going to change quite a bit over the next few years. You have to adjust to that.
Mr. Blanchard, do you still see emerging markets growing faster than developed markets long term?
Well, there's no question about this. I mean, the emerging markets are going to continue to grow much faster than advanced economies. And again, the advanced economies, for many of them, are the technology frontier. It's very hard to advance there. Emerging markets still can learn a lot from advanced economies, grow faster. So I have no doubt that they'll continue to grow faster, yes.
Mr. Blanchard, now IMF has talked about the need for reorienting growth in emerging markets, such as reducing the dependence of investment-led growth in China and curbing the consumption-led growth in Brazil and Turkey. What other growth reorientation would you like to see in emerging markets?
Well, I mean, you said it exactly right, which is that it's not the same recipe for the various countries. In China, investment is at least some margins too high. It has to be reduced. Consumption has to be increased. In some countries, India, Brazil, there is room to increase investment. So it really depends on the country. Each country has its own problems. They have to be tackled if growth is going to be sustainable and balanced.
So should India reorient its growth to an investment-led model that Prime Minister Modi is pushing for? You know, there's this whole Make in India effort that's going on. What's your view on this growth model for India?
Well, I think investment in India should be a bit higher, we think, and therefore measures which remove some of the obstacles to investment, administrative obstacles and others, should be removed. And I suspect if this happens, investment will indeed increase, and so growth will rely a bit more on investment than it does now.
Mr. Blanchard, in your view, what are the key risks posing emerging markets? Which emerging markets are better positioned to weather the liquidity conditions globally, and which EMs are most at risk?
Well, we had a trial balloon with a so-called taper tantrum last year, so we know a bit what can happen. And what's going to happen is when the interest rates in the US are higher, investing in the US will be relatively more attractive. So some of the capital flows which were going to emerging markets are going to turn around, come back to the US. How different countries are going to be affected, what we learned is investors are fairly discriminating. If they are worried about a country, they take their money out more from that country. So this is to a large extent what happened in India last time. I think if we look forward, a lot has changed in India over the last year, say, and therefore the current account deficit is smaller. There are all kinds of reforms which are coming in play. So my guess is India would do much better this time than it did last time.
Mr. Blanchard, which EMs are most at risk?
Well, I'm not going to name names, but clearly when, foreign investors look, you want to have a fiscal balance, a fiscal situation which is healthy. You want to have a current account deficit which is not too large. You want to have responsible policies. So any country which doesn't have that is more at risk than the others.
Are you optimistic about global growth?
Well, sanguine is a bit is too strong. No, I mean we're probably going to revise the numbers down a little bit. So sanguine is clearly not the right word. For the U.S., am I fairly confident that the recovery will continue? Yes. We think that the fundamentals are right. The rate of growth is not going to be incredibly high, but we expect sustained growth for the foreseeable future.
So do you see capital outflows into the US affect emerging market currencies?
Well, again, this is going to have, if you're a country where capital flows are turning around and going out, there's going to be pressure on your currency and there might be some depreciations. It's probably going to increase your interest rate. Long-term interest rates in India kind of move more than 1-for-1 with long-term rates in the US. So it's going to lead to tighter financial conditions, a depreciated exchange rate. In some countries, reserve FX intervention may help, but that's going to be the kind of scenario that we have to be watching out for over the next 6 months to 2 years.
What is IMF's view on the Indian rupee?
The IMF doesn't have a view on the Indian rupee. Or at least I don't know it.
Will capital flows impact the currency downwards?
Again, I mean, if capital flows go out of India, there'll be pressure on the rupee down. I'm quite sure it will not be with the same intensity as we saw last time, but there might be some pressure on the rupee down, yes.
Now, Mr. Blanchard, how does IMF factor in geopolitical risks in their overall economic outlook?
Well, clearly, I mean, there are geopolitical risks. I mean, so far, we don't see much effect of these risks outside of the regions which are directly affected by them. One place where you might have expected something to be visible would be the oil market, for example, given the turmoil in the Middle East. But as you know, the oil prices have decreased quite a bit, which reflects both supply and demand factors. So it hasn't had a major effect. You would have expected them to increase a lot. They have decreased. If you look at measures of volatility looking forward in that market, they're also very low. So it looks as if the markets are not very worried. It doesn't look like it has had much of an effect on the price of oil. There are other channels, it could be confidence factors, but so far we don't see much. Now looking forward, things could get worse, and then it would be a different ballgame.
So the end of QE does not signal a change in the era of easy monetary policy for you, and therefore something people should be worried about?
Again, the end of QE, in general, the normalization of monetary policy in the US, maybe in the UK as well, will come because there is strong growth and a recovery in the US and the UK. So for the rest of the world, it's a mixed blessing. You have the growth effect, so higher exports to these countries. At the same time, you're likely to get high interest rates. That's an adjustment which has to take place, and with a bit of luck, it will be smooth. There might be a bit of turmoil along the way. We've learned that. It may last for a few days, maybe even a few weeks. But in general, that's something which has to happen and which fundamentally is healthy.
Mr. Blanchard, my last question to you. You seem pretty sanguine that the end of easy money and higher rates in the US is not a concern for global growth. Am I correct?
No, again, first because we know it's going to happen. So, people have taken decisions knowing that this was going to happen. And again, it's going to happen because the US economy has largely recovered and it's time to increase interest rates. So you have these two pieces of news. Higher growth, higher interest rates, that has implications, but on net, it's a good thing.
Thank you, Mr. Blanchard. It was a pleasure having you on the show. That was the chief economist at the International Monetary Fund, who believes that a rate hike by the US Federal Reserve would in fact mean that the American economy is on a better footing. And instead of worrying about short-term financial shocks, emerging markets like India must look at it as an opportunity to push more exports to the US. Up ahead, are the emerging markets prepared to face a possible flight of capital when the Fed hikes rates? That and much more with Harvard professor Gita Gopinath on the other side of this break. Welcome back to Global Insights with me, Punita Kumar Sinha. As the easy monetary policy in the US stares at the inevitable end, even the emerging markets are a nervous lot. The gush of global liquidity that has supported emerging market equities in the recent past, what if it traces its way back to developed nations once the interest rates there are more lucrative? How serious could the consequences be for emerging markets? To answer that, we have with us Gita Gopinath, a professor of economics at the Harvard University. Thank you, Gita, for joining us today. Gita, Mr. Bernanke's term has ended, and you had said that as long as he is at the helm of the Fed, we need not worry. Should we worry now?
Right. No, I think there's a lot of stability with the what's happening at the Fed. I mean, Janet Yellen is terrific, and so I expect that the policies will be fairly similar to what Bernanke followed. So I don't think there'll be any big surprises there.
What are the risk factors for EM economies according to you? Are these economies adequately prepared for the end of QE?
Yeah, so I think what's going to matter, again, like I said, is not so much the end of quantitative easing as much as the increase in the Fed funds rate and how that happens. That's going to impact, that's going to have the next big policy shock on world markets. So what matters really, in my opinion, is like three factors. It depends upon what growth looks like for these emerging markets. It depends upon the size of the current account deficits. It depends upon the size of the reserves that these countries hold.
So what factors do you believe are the most critical while determining which economies in emerging markets would be adversely impacted?
Right. I mean, the first variable that I always look at when I think about what's going to happen with interest rates in the center or in the US when they start going up is the size of the current account deficit, because that number, the 1.7% of GDP, basically tells you how much India relies on external capital inflows. And so, the fact that that number is low, gives me reason for cheer. Now, you bring up a good point about inflation. I think what that translates into is what's going to be the value of the rupee in the future. And so if there is concern that inflation is going to stay high, which eventually will weaken the value of the rupee, then, then investors might be more concerned about sending money into the Indian market. But here's another thing to keep in mind. So when the Fed started cutting interest rates in 2007, they brought it down from about 5%, a little over 5%, 5.25%, I believe, all the way down to 0.25% in a matter of 2 years. Now the question is, where is the Fed headed, right? Are we expecting the Fed is going to go up to 4% or 5% gradually, but will it go up to those numbers? If it did, I think the impact on emerging markets can be fairly substantial. But we're not in that situation. If you look at the discussions going around at the Feds about what they think is potential GDP growth in the US, what they think the real interest rates, kind of what is the relevant real interest rates. If you listen to kind of Larry Summers' views on secular stagnation, the real interest rates that seem kind of more normal is closer to the range of 1% and nowhere near 4%. So we're not talking about a return to very high interest rates. What I think matters more than the level of the interest rate, what matters is, you know, how much of uncertainty surrounds Fed policy, and this is where the Fed communication becomes extremely important.
Now, Gita, interest rates are projected to rise to about 4% in the US. So investors who are currently liking emerging market bonds, wouldn't they actually move back to US bonds?
Right. So again, just to clarify, I do not think that the interest rates are going to go all the way up to 4% in any kind of a reasonable time horizon. I mean, so you know, the point I was trying to make is that the growth potential in the U.S. market, so kind of what we would call the natural real interest rate in the U.S. market, seems closer to 1%. In which case, the Fed, you know, with inflations of, if they get their inflation target of 2%, they might go up to 3%. You know, try to target about 3%, but it's low. I mean, these are low numbers. The overnight Fed funds rate is not going to go up to 4% you know, in 2 or 3 years or any such horizon. So then the question is about yields. What's the expected yields in emerging markets? And I do think that emerging markets offer better yields at this point. So the question is whether you can provide a stable environment, whether you can provide the prospect of growth, whether you can keep a stable currency, whether it can look like you're not relying heavily on portfolio flows. So I guess I'm more optimistic about the emerging markets' ability to withstand these interest rate increases, which I do not think will be very, very large. And the investors who chase yields will still find a good reason to tap emerging market government bonds.
Gita, do you expect volatility in currency markets at the end of the tapering like we saw last year?
Right. So I don't think that the tapering ending in and of itself will have much of an impact on currency movements, at least not. I do not expect to see something of the kind that we saw last May. Markets respond much more to kind of unanticipated events, and at this point, this is a very anticipated event. There's a clear signal that quantitative easing will end. There's a clear signal that the Fed is not going to go out and sell its assets. So I think that's going to be a little bit of business as usual. There's going to be the markets are not going to respond that much. Now that's in my opinion, the bigger effect is going to happen when we get closer to the middle of next year, when there is an anticipation of interest rates rising. Now that said, it is true that we've had a few months of fairly tranquil currency markets and extremely low risk in those markets and in equity markets. And so, that could be the calm before the storm. I don't think there's going to be a big storm, but there could be some small turbulence in the markets.
But do you expect markets to get more volatile?
Right. So again, I expect there might be some increase in volatility, but since all of this is so anticipated, and most of this has been priced in already, if you look at long-term yields on sovereign debt, most of the action happened last summer. I don't expect to see any big movements in the next month or so.
Gita, which emerging markets look most vulnerable to you?
Right. So if I look at the BRICS nations, I mean, Brazil is one market that it's not doing well in terms of growth. It shrunk by like 0.6% in the most recent numbers. Its current account is 3.6% of GDP. The shrinking GDP, that current account deficit as a share of GDP is just going to go up. There is a lot of uncertainty about the politics in Brazil, about where things are headed for that economy. So that, for me, is was one country that is potentially open to more risk. Turkey has an interesting mix. I mean, Turkey has more growth, but it also has an 8% current account deficit. It was one of the countries whose exchange rates was most hit last time around, and I believe it still is a risk factor. And Russia, of course, has its problems. The whole issue with Ukraine. I mean, that's a big issue. So and all of the problems associated with that. So that remains. China, China has other issues. It's still growing at at enviable rates, but it has an overheated housing sector or a banking sector that has problems. So in this horizon, I guess I'm more optimistic about India. I mean, India has a current account deficit of 1.7%. Growth looks promising. It's going to depend a lot on what this current government can get done in the next 6 months. I think if there is any disappointment, there could be pullout from India. We have Dr. Rajan, who's at the helm of monetary affairs. So, I guess I have a more sanguine approach to the risks in India.
So, Gita, it appears you've changed your view on India in the last 1 year. You were quite concerned about India last year. Has that anything to do with the elections?
Yes, and that's because a lot of things have changed in India. So the last time I was asked this question, the current account deficit was over 4%. Inflation seemed like it was out of control. Growth prospects looked dim. It looked like an economy that one couldn't put too much of faith on. And lots of that has changed in the last 8 months.
So, Gita, you're not worried about global growth under a new policy regime with no easy money and higher interest rates?
Yeah, so we certainly are entering this era of higher interest rates. But again, to put things in perspective, the reason interest rates are going up is because the U.S. economy is coming out of a period of very, very slow growth and looks, at high unemployment. And it's always good to have the world's largest economy in a healthy situation, so that there is a reason why interest rates are going up. The piece that can have a tumultuous effect on markets is kind of the risk associated with interest rates going up in the U.S. So if there is an impact on, as interest rates go up, there is an impact on the financial stability of economies. If there is, for some reason, there is a change in asset prices that affects banks' balance sheets. If that pushes the financial situation into the red, that's the only situation in which I think that this particular increase in interest rates and end of quantitative easing will have a negative effect on growth.
So, Gita, my last question to you. Is it fair to say that you do not expect nervousness like we saw last May to happen again?
Right, so I guess the way I would describe what happened last May was not so much it was the end of, or the easing or the rolling back of quantitative easing that was the problem, as much as how the whole thing was communicated. I think that it was a surprise factor that was the bigger deal at that point. And in fact, Bernanke, who first made that statement, kind of rolled it back and said that no, actually we are going to take things far more slowly. So it was not so much the policy action itself as the kind of the uncertainty associated with the policy action that kind of generated all this panic in markets. So my hope is that the Fed communicates a lot better what it's going to do with the Fed funds rate. And if it manages that, if it does it gradually, which I'm fairly certain it will, it's not going to go and raise interest rates sharply anytime soon. If it gives markets enough forewarning that this will happen, at the time of such announcements, there will be some small turbulence in the markets, but I do not expect there will be the kind of turbulence that we saw last May.
Thank you, Gita, for your views. That was Harvard professor Gita Gopinath, who says India is much better placed to deal with the consequences than Brazil or Turkey. Well, today we have heard from both our experts that the US economy is on a strong footing to be able to deal with the end of QE and perhaps a higher interest rate regime. The pace of overall global growth, though, still remains sluggish. The Eurozone is facing real threat of deflation, hence monetary stimulus may continue there. And Japan has its own challenges. the BRIC economies are seeing continued risk of macro imbalances. India stands out as a relative outperformer due to its improving current account deficit. It still remains to be seen, though, if US interest rates will indeed rise and when, and what that may do to capital outflows in EM currencies. If September is any indication, we have to brace ourselves for more volatility in the year to come. Thank you, viewers, for joining us. Do tune in again next week for more global insights with me, Punita Kumar Sinha.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.